So this live is all about loan accounts, unpaid present entitlements, and my thoughts on how to handle those when it comes to estate planning. So debunking the balance sheet. And I know that we have got a really diverse range of experience in the group in terms of the accountants, obviously reading a balance sheet, no brainer, through to maybe a family lawyer or, you know, someone else who's had a lawyer who may not have had too much financial experience, and you're sort of learning how to interpret these documents on the fly. So what I thought I would do is just let you know my process when I'm working with clients on their estate planning strategy and we have loans in the group. Okay, so let's get into it. Great, okay. So there were two main scenarios that I wanted to cover off in the live. So the first one is when the borrower is an individual. So basically the testator has made a loan to their children, family members, friends, that type of thing. Or the other scenario where we're relating to a family trust. So we've got a loan owing by the family trust to the testator, or they have an unpaid present entitlement from that trust. So let's start with the first, nice and simple. I think this probably comes up more often depending on your client base. The one thing I just want to do though is show you this little table, because this is something that I always do in my estate planning exercise with my clients. And I like to get the background material first, and then we just go through this table here together to make sure we've understood all of the assets in the estate plan. So obviously the estate plan aims to be robust enough to deal with changes in the assets. But I firmly believe that understanding the exact assets that we're dealing with when preparing a will means we can be on the front foot with trying to cover off where those assets are passing as in the strategy as comprehensively as possible. So I always try to make sure I've got on my checklist that loans owing to clients by their children or family members are covered, and I specifically ask them, and you know, have you lent money or gifted money to your kids? Because often people will not tell you that they've done that, or they've forgotten about it, or they don't see how it's relevant for the estate plan. And then I also always ask for the balance sheet for any entities. And again, I often get resistance from some clients going, oh, why do you need to see the financial statements? And then I kind of have to explain, you know, loans that coming to and from your family trust that you may not even be aware of. A lot of clients don't think of it as loans. They just think of it as like a line item on the financial statement. They can't foresee how that's going to flow through to the estate plan. But it's really important to ask for the balance sheet. I don't worry so much about the profit and loss or the tax return. It's just that statement of financial position or the balance sheet, because if there are amounts owing to a testator, they are going to be covered by the will in this first column here. So I always think this is a worthwhile exercise to do with a client, and you go through it, you can kind of see, you know, wealth that might have been in this last column in a non-estate asset might be shifted into the column that is covered by the will. And then that I've got some examples of how that can have some pretty significant flow and consequences. I'll also just say, please feel free to send through your comments. I can't see any comments at the moment, so I'm assuming no one has sent any comments through. But if I do apologise if you're sending through comments and I'm not seeing them, but feel free to ask questions as we go. And I've put together a little prezzo, but really I'm happy for this to be interactive and to answer questions and, you know, get interrupted as we go. So feel free to send those through. So let's talk about this when the borrower is an individual. So loans to kids, family members, friends, that type of thing. So this is my process. Step one, make sure you have a system or a process for identifying this with your clients and picking it up. And I'll just do a little shout out to Lucy Percy, because Lucy was talking about this in her Instagram stories last week, and she said she was up to like several $1 million this year alone of undocumented loans when she was doing estate planning, where she had to identify that with the testator and they didn't tell her, and then they had to go and sort it out. So that kind of got me inspired, going, yeah, this is a big hidden or sleeping issue that can really, I think, trip us up as advisors if we don't have this on our checklist. So make sure it's on your checklist or your meeting agenda or whatever you do, to specifically ask the clients, because I can't tell you the number of times where they've told me they've sent me through a list of all their assets and they never include loans to their kids or their brother or whomever. So step one, identify. Step two, decide how to document it. I think it's really important that we do document amounts that have gone out to family members, friends, business partners, that type of thing, so that we have clarity around whether it is a gift or a loan. So do a simple deed of gift or a loan agreement, ideally with security if you're going down that loan agreement path, just so that we can remove uncertainty, remove disputes about whether it was a loan or a gift. And, you know, that's a big one, you know, fighting over, is it a loan, is it a gift, particularly where you've got loans to children and they're not all, you know, there's multiple children that haven't all received equal contribution from their parent. Do they have to repay it? Was it a gift? Obviously, people are going to be arguing different things there depending on what is going to be most advantageous for their position. I think we had a question in the group last year where there were amounts to a sibling, and that sibling died, and then the, you know, sister-in-law was arguing it was a gift. The client thought it would be repaid on death. You know, it was a huge mess. So just document it to remove that uncertainty, remove any dispute. My understanding is that if it's not documented and a contribution has been made to a person, or, you know, payment has been made, the presumption is that it's going to be a gift. So if you want to be, if your testator wants to have the option of having that amount paid back, document it as a loan. And look, I often suggest to my clients, even if they want it to kind of be a loan, or want it to be a gift, you know, they're helping out the kids with purchasing a property and they don't really expect repayment, that we still document it as a loan, because that gives us a big head start when it comes to asset protection on bankruptcy or divorce. So I will just show you what I mean by that. And again, this might be bread and butter to some of you, so I'm just including it to kind of round out the comments. But let's say we've got our testator, this is our client here, and they want to help out the children with buying a property. So say she's got a son and she wants to give him $750,000. Super generous, I know, to buy a home. And so the son and his partner are contributing $50,000 to buy a property worth $800,000. So do we do that as a gift or a loan? If we do it as a loan and we put in place a loan agreement, and that loan agreement might have really favourable terms, you know, interest-free or very low interest, repayable on demand, really long loan term, and then we have a mortgage over the property supporting that loan, it still feels like a gift to the family while during their lifetime, while servicing that asset and maintaining the loan. You know, they're not really repaying it. They might make a few repayments just to kind of refresh it and make sure that the clawback period doesn't expire. but, you know, basically feels like a gift. But say we have a bust up here and there's a relationship breakdown or a divorce, then in that case, our testator, our client, has the right to call back the $750,000 that they were going to, that they had contributed into the equity, so that we don't lose, you know, potentially half of that gift to the client on a relationship breakdown. We can at least, you know, claw back some of that initial amount, and then, you know, maybe loan it or loan it again in the future once that relationship breakdown risk has passed. So I always think it's worthwhile doing it as, you know, a loan on very favourable terms, even if the intention is as a gift. So I don't know if anyone has any comments on that, if they always do that, if they always go the other way and document it as a gift, but I think it's worthwhile doing. And for the family lawyers who are watching, you know, let me know what you think about that from a family law perspective. It certainly is very powerful on a bankruptcy perspective. So then, of course, though, we need to, if we're putting in place this kind of arrangement, we need to look at, well, what happens as part of the estate plan as well. So step one was identify, document, and make sure that we know what we're dealing with. Step two is to decide what happens on the death of the lender, so under the estate planning strategy, because remember that right to receive repayment of the loan will be an asset on the testator's balance sheet. So I've come up with a couple of options. I mean, these are not an exhaustive list, but, you know, some of the common things that happen. So first option, do nothing. And I mean, you can proactively do nothing, or you could do nothing because we didn't know about the loan, and that, you know, could be problematic, obviously. So if we do that and it forms part, it will just form part of the net estate if we proactively don't address it. And then that will require repayment to the estate by the borrower. And that can be an issue. I've got an example of why that's an issue, but say you've got 3 adult children and one of them has borrowed funds, and there's a loan that, firstly, we've got to fight about, is it a loan? Is it a gift? You know, people, the other siblings who aren't the borrower will be arguing that it was a loan. The borrower child might be arguing it was a gift. They don't want to repay it. They don't want to have it offset against their share of the net estate. You know, let's avoid that issue by documenting it as a deed or a gift. Sorry, a gift or a loan. Secondly, if it is a loan, a documented loan, and we don't address what happens to it and it forms part of the net estate, say the will says the net estate passes to the 3 children in equal shares, the 2 non-borrower children could be putting their hand up saying, well, we want repayment of that amount. Whether the borrower child is in a position to repay it or not, you know, could be a real problem there. So do nothing, but do nothing proactively and make sure it works. Alternatively, you might offset it against the borrower child's entitlements under the will, so that we don't force a repayment, but they basically are repaying it because they get a lower share under the will. And, you know, one of the advantages of documenting it is also making sure that when you are documenting it, we have a mechanism in place so that we can work out, well, how much is outstanding at the date of death, you know? Is that child making repayments or not at all? Is there interest? How are we going to work it out? Because sometimes these are arrangements between family members and kids, and they like, it's in an email chain, or they just kind of have an unwritten arrangement, or there might be a spreadsheet somewhere, but no one really knows. So as part of identifying and documenting, just make sure that there is a way for everybody to know how much will be outstanding at the date of death, and that's really clear. There's no ambiguity there either. Another option that testators often say is like, yeah, I want to forgive the repayment. So basically, we wanted to treat it as a gift, but on your advice, we've documented it as a loan because if our child goes through a relationship breakdown, we don't want to lose that equity that we've contributed. So we want it as a loan for asset protection purposes. But if we die, we don't expect it to be repaid. So they'll often say, can we just forgive it on death? Which you can do. There is an alternative, though, that I like to do if we're using a testamentary trust under the will. So instead of just saying, I forgive, all amounts owing to me or this particular amount from child A, instead of doing that, you could actually gift the right to receive repayment of the loan to the testamentary trust for the borrower's testamentary trust. So I'll show you in a diagram because that's a lot easier than explaining it. So remember our scenario here. We had the parent who had contributed the $750,000 to the property purchase for the child. So instead of just forgiving that debt, if the will set up a testamentary trust for that same child, the will could say, I give the right to receive repayment of the amount from child A under the loan agreement to the trustee of the testamentary trust for child A. And then we basically substitute the parent with the testamentary trust. The same loan agreement applies, if you have one that extends to successors and assigns. And we then have a protected testamentary trust having the right to receive repayment instead of that $750,000 amount of equity basically being subsumed into the relationship equity. We have it still going to go back to a testamentary trust. So that is great for asset protection, family law, and again, family lawyers jump in or throw in your 2 cents, please. But it's better than it being forgiven completely. It's not always bulletproof with a testamentary trust. There's a lot of factors about whether the assets of the testamentary trust would be relationship property under a relationship property settlement. But it gives us a good head start than just totally forgiving it. And then that child can decide, maybe they have got enough money to repay it, and we're transferring this $750,000, we're contributing that into a testamentary trust environment, which can then be invested and earn accepted trust income treatment. So we're kind of changing the characterization of that gift from an amount that is not going to be eligible for accepted trust income treatment to potentially being eligible if the child chose to repay it into the testamentary trust. If they don't choose to repay it because they don't have the money for that, then they can just continue having that, really favourable related party loan agreement term on foot where, they might make a few payments every now and then to refresh the 12-year period by which the loan would expire afterwards. And I've just had a total blank about what that's called. So if you remember, if you know what I'm talking about, throw it in. But basically, the loan will expire and you can't really bring an action to enforce the loan after 12 years for secured debts, at least in Queensland. That's the rule. Sorry. I prefer to do this strategy. If a client says, I want to just forgive the loan and we're using testamentary trust, then I prefer to actually forgive it by gifting the right to receive repayment to that child's testamentary trust. A bit more complicated if you're using a single trust for all children, but if you've got a testamentary trust for each child and they have loans from their parent, then this is worth considering. Okay, what about when the borrower is a trustee? Yes, statute of limitations. Thank you. Thanks, Nikki. Yeah, baby brain is real at the moment for me, so thank you. Okay, What about when the borrower is a trust? So again, this is where we've got that leakage from wealth that would have been in the trust company column, that if the borrower is a trust and owes money to an individual, then we're moving that amount, we're leaking it out of the non-estate column, for everything other than New South Wales, into the will column, which can be significant. I've got a live example that I'm going to show you in a moment, which is from a client I worked on last year. So, but first, I promised I would demystify and debunk unpaid present entitlements. So for the accountants, the financial advisor guides, UPE might be something that you're super comfortable with. Some of the lawyers, you may not even know what UPE means. So just so that we're all on the same page, it means unpaid present entitlement. It arises largely from a tax concept, okay? So as you probably all know, trusts are flow-through vehicles for tax purposes. So every 30 June, from a tax perspective, the trustee should be distributing any income that they earn out to the beneficiaries rather than accumulating it. If you accumulate it, you get taxed at the trustee tax rate, which is not a good tax strategy. So every 30 June, the trustee should be creating, where's my highlighter? Present entitlement in the income that the trust earns to a beneficiary. So that basically gives them a right to demand payment of that income. The unpaid present entitlement happens where the trustee distributes for tax purposes an amount to a beneficiary at tax law and trust law, but they don't actually pay through the cash, okay? So a really specific example, last 30 June, the trustee of the Lucke Trust distributed $50,000 to me. I reported that I received a $50,000 trust distribution in my tax return, and I paid tax on that. And there is a distribution resolution by the trustee saying that it distributed $50,000 to me. But I kept the $50,000 in the bank account for the trust, and I didn't actually pay it through because I could have had a difference between taxable income and actual income, like accounting income versus what's taxable, because there are different tax, I might have had some deductions that were not allowed, but I spent the money still, and I didn't have enough money in there, or I wanted to use that money for next year's working capital or something like that, which happens all the time. Often the money won't come out, that comes out of the trust bank account, doesn't line up with the actual, taxable income and taxable deductions that come out from a tax perspective. So I was allocated money, but I didn't actually receive it. That's why it's called an unpaid present entitlement. From a trust law and tax perspective, I was presently entitled to the $50,000, but the trust did not give me the $50,000. I hope that makes sense. If you want more clarification on that, let me know. So the strict legal position is that it's actually not a debt or a loan. It's like an equitable entitlement. Okay, so, if you wanted to assign a UPE, or if I was like, I want to give my UPE to my husband, I'd have to convert it to a debt first, then assign it. But ignore that really from a practical perspective. You should just consider it to be like an at-call loan, because I can basically say to the trustee of the Lucke Trust, I want my $50,000, please. You owe me $50,000, I will call on that whenever I like. So there's a slight nuance there, but when it comes to estate planning, just consider it an at-call loan. So demystifying the balance sheet. I've got two examples of balance sheets from real clients that I have redacted, just to kind of show you where to look. So, and as I said kind of earlier, I don't really worry about the profit and loss. If it's like a proper restructuring job, or I'm trying to really understand the nature of the business, I'll look at the profit and loss because that will be informative. But just in terms of assessing assets and liabilities, I just look at the balance sheet. So usually with your balance sheet, as you probably, if you've looked at them, you'll see there's usually like a headline page or summary page with the assets and the liabilities and then the equity, right? And if anyone who can remember any of their like accounting training, it would be assets minus liabilities equals equity. So it's good to always have a look on the first page, and obviously an asset, we've got a loan here, that's an asset. So someone owes this trust $100,000. And then we've got the loans that are liabilities. So this is where the trust owes someone else money. So in this case, we've got beneficiaries accounts and 3.3 million. This is a real example. And it's a bit weird, right? Because when you look, we're dealing with big numbers. This trust has got like $3.8 million worth of assets, but then they've also got about $3.8 million worth of debts or loans. So net position neutrals out, they have a negative $346 position. So you kind of just go, oh, well, like, what's the trust worth? If you looked at it in that sense, you go, oh, that trust really got a net asset position of nothing. But then we look at who these debts are to, and actually they're related to the controllers of the trust. The debts are to, in this case, basically to the wife, who is one of the directors of the corporate trustee. So we still do have a valuable asset here. So you've got to you can't just look at the headline net asset. You have to dive in. So great, we've got beneficiary accounts of 3.3, and then also the wife had a separate liability of $580,000. So she had, it says replaced margin loan. So she had basically contributed funds to refinance a margin loan. But this page on its own doesn't tell us who those beneficiary accounts are for, right? So then you have to dive through the pages to the notes. So I extracted this from, I don't know, it's probably like page 10 notes, where it goes into more detail about the beneficiaries' accounts, and it has a nice summary. So, and then it should, and they all look different. All financial statements end up looking different. But it should actually tell you who the beneficiaries are. So what I've redacted is each beneficiary's name. This beneficiary one was the wife. So she had contributed funds. She had received each year share of profit, which means unpaid present entitlement, basically. And then they've carried over her balance each year. So at some point, she's been distributed a large amount that has not been paid, and it keeps, every year that she gets her share of the income, and it just keeps going up and up and up, right? So to the extent that the trust owes her almost $3.3 million at the end of 2018 financial year. So this is 100% worth knowing. If the clients had just said to you, oh, look, the net asset position is like $300 minus $300, you go, okay, don't worry about that trust. There's nothing in it. When you look deeper, the trust owes the wife almost $3.3 million, which is an asset in her will column, When we're looking at her will and her assets, it's a big deal. So let's say this is the wife's estate column that I would table that I would put together for her. So they own the family home as joint tenants with her husband. she has reversionary pension to her husband and he has a reversionary pension to her. And we've got that family trust, which, as we can see, had about 3.3 million of assets. And I'll just dive into that. What I've redacted here is specific assets. So they actually do have a decent amount of wealth in this trust. It's a valuable trust. There's almost $1 million of cash and other valuable assets sitting there. And it just looks like there's nothing because of the unpaid present entitlement to the wife. So we've got a valuable family trust as well. If we did not look at the UPEs, you would actually look at this and say, there's really not much wealth passing under the will, right? Joint tenants go straight to the survivor on her death when she dies, reversionary pension to the surviving husband, and the surviving husband can just take over the family trust. So the types of questions that come up in the normal estate planning exercise would really be impacted by this UPE. So the question of like, when would you set up a testamentary trust? So if we had like, you know, this couple, let's say they're in their like 50s and they had like adult children in their early 20s, but no grandchildren yet. And as we saw, most of the assets were held as joint tenants, reversionary pensions, and in the family trust. You know, when would you set up that testamentary trust? Would you bother having a testamentary trust on the wife's death for the husband? Or would you wait and just set up, if they had 3 kids, set up 3 testamentary trusts once her and the husband had both died? Because typically I would do that. I would say, oh, well, we're not really having anything going through the estate in the first instance. Everything on the wife's death will go to the husband anyway. And then when he dies, we'll set up 3 testamentary trusts for each of the kids. But because we have that UPE, and in this case, the husband was a high-profile director of a listed company, it made sense, I thought, to set up a testamentary trust on the wife's death in the first case, so that we can run that 3.2 million through a testamentary trust. We get asset protection from a bankruptcy perspective for that surviving husband. You know, depending on when she passes away, if grandchildren come on the scene, they could choose to flow money from the family trust to the testamentary trust and repay some of that unpaid present entitlement at their election, at call, so that we're converting income from an environment that could not distribute to minors more than the 420 bucks to an environment where we get the full tax-free threshold of accepted trust income treatment on that money to minors. So that's a great opportunity to have in the back pocket. You don't have to repay that unpaid present entitlement. You could have it just sitting there so that the family trust continued to owe it to the testamentary trust and it stayed on that balance sheet indefinitely, like they had done with the amount owing to the wife. But if they wanted to and the accountants thought it was a good idea, they could start repaying some of that unpaid present entitlement and getting it into 3 million into a testamentary trust environment, which is a pretty good outcome. Again, we have that decision. Do you just forgive it? She could have said in her will, I forgive any amounts owing to me by the family trust, subject to tax advice, if there was Division 7A consequences and that type of thing. So get the accountant to sign off on anything you do like that. And again, this is another example of where gifting it to a testamentary trust instead of doing an outright forgiveness could be the smarter option. If there was a different scenario and we were looking at this and actually saying there could be a family provision application claim here. So say that wife actually had a child from a previous relationship and we were worried about that child challenging the estate. If I had not looked at the balance sheet, I would say, and say they weren't in New South Wales, we didn't have to worry about notional estate, I would say, you know what, we're okay. We don't really have to worry about family provision application in the first instance if the wife dies and leaves everything to the husband, because the family home goes automatically as joint tenants. We've got a reversionary pension outside the challengeable pool, family trust outside the challengeable pool. That if I had not looked at the financial statement, I could be in a world of trouble, because actually the challengeable pool is 3.3 million. And it would, you know, it would force the assets in the family trust to have to satisfy that claim. So to me, that's huge as a practitioner, and making sure that we protect ourselves. Having a look at the balance sheet is critical. So if you're not looking at financial statements, then you need to be, especially when you're giving advice about whether steps need to be made to be proactive about the family provision application. Oh, and no, thanks for tuning in, Nikki. I'm sorry I have gone over time. The replay will be up as usual. So thank you very much. And thanks for filling in my baby brain. So let's have a look at a second example. So in this case, let's say we've got our testator here. He's got one child, one son, and he's got a second wife. So the relationship with the son's mother didn't work out. He's got a new wife now. And under his estate, he wants to give his business, which is in a family trust, to the son, and his listed shares to the son through a testamentary trust. And then everything else is going to the second wife, super, the net estate, that type of thing. Let's have a look at his balance sheet. Again, this is a real balance sheet, but a different client scenario. So in this case, we're looking at that headline page. So current assets, current liabilities. We've got a net asset position, again, of $10. They tell you this trust has only got $10. Except, you know, there's a $1.2 million asset here. It's got accounts receivable of 1.2, cash of 7.5. It's a valuable trust, but we've got liabilities that counteract those assets to make it look like the trust doesn't have any wealth. So unpaid trust distributions, same as an unpaid present entitlement. Financial liabilities, we want to know, who does this trust owe money to? And just on that note, so I'm focusing on what do we do when the testator is owed money. But as part of this, it's also really useful, you know, have we got a liquidity issue, a bankruptcy issue that the executors are going to have to deal with? So also, you know, projecting those types of cash flows is also worthwhile doing when you get the financials. But I'm not really focusing on that for today's topic. We're just going to look at, well, what about loans that are assets to the testator? So unpaid trust distributions, cool. Again, there's $480,000 there, but we don't know who it's owing to. So we go to the notes. There's usually always notes that will tell you. So in this case, we've got the unpaid trust distributions. The person I've blacked out here was the testator, and the testator was owed $480,000. So the UPE basically is $480,000. And as you can see, nearly all of it was from this year. So they earned $448,000. Oh, sorry, that's not right. They actually, this year, they actually did distribute all of the income and they paid the cash out. So this is just an ongoing unpaid present entitlement that they keep carrying over year to year. So no unpaid present entitlement, all the present entitlements were paid this year. So that's not really relevant from an estate planning perspective, but if you're trying to just kind of understand this, that's what that means. So let's flow through the options and the consequences from an estate planning perspective. If we did nothing with this UPE, either proactively did nothing or we didn't know about it because we didn't get the financials, it would form part of the net estate, right? An amount owing to the testator is one of his assets. If he gives everything in the asset to the second wife, then that amount is owing to her. It's owing to her from the family trust, which has the business that the son is inheriting. So doing nothing in this case could create a huge issue because the son inherits that trust. He takes over control of the trust through appropriate succession mechanisms. And all of a sudden, this business that he thinks is worth, you know, 1 million or whatever it was, owes his stepmother $480,000. And she can call on that debt whenever she wants. So if he may not have the liquidity or the money in the business to pay that, it could really jeopardize the financial position of the family trust, and not to mention their relationship together. That's a bad outcome, right? Alternatively, if we know about it and under the will, we say the amount owing to me from the family trust is gifted to the trustee of the testamentary trust for my son, then the son owes that amount to his own testamentary trust. And he can choose whether he leaves that amount on foot, whether he gets tax advice and chooses to forgive that amount, or whether he decides to repay it, shifting income from this family trust that cannot make tax-free distributions to minors to a testamentary trust that can make tax-free distributions to minors. So suddenly, you know, the $480,000 goes from a non-accepted trust income tax treatment environment into an accepted trust income tax treatment environment. Gives him so many more options to get appropriate advice and decide what to do. Not to mention, we've got a nice little firewall between the second wife. She gets her net estate, the son gets his business and share portfolio, and they don't have to have an argument over it. So again, really valuable reason for looking at the financial statements and making sure that we address these unpaid present entitlements and loans appropriately. So this would be the same if the testator, rather than it being an unpaid present entitlement, if he had just loaned money into the trust, like contributed to the working capital of the trust, and it was recorded as a loan instead of like a equity contribution. Same deal, right? My big tip for the lawyers, involve the accountants. You know, I'm a huge fan of accountants and financial advisors and lawyers all working collaboratively. And this is a perfect example about why. Because the accountants firstly can tell you what's going on, because usually the financial statements are a year or two behind the date that we're making the will. So they can tell you, well, usually they might know, depends how involved they are in the client's business, whether those amounts are still on foot, whether they've been repaid that year. They might have their own strategy with the client about when those amounts would be repaid, or are those UPEs getting bigger and bigger. So involve the accountant. They can then also make sure that we're not doing anything that is going to trigger adverse tax outcomes. So we've got commercial debt forgiveness rules, Division 7A, Division 7EA. So these are deemed dividend rules. They apply to forgiveness, assignment, and also just where we need special loan agreements as well. So always a good idea to involve the tax accountants for anything that we're recommending from an estate planning perspective, just to okay it. So that's a nutshell on what I do with loan accounts, gifts, and unpaid present entitlements. Thank you for the comments, and if you do have any more comments as you're watching, if you're watching the replay, just throw them up in the video. I will aim to answer them. And yeah, hopefully this has given you some food for thought about some strategies that you might consider if you have clients coming across your desk with these loans, and also if you're not already sort of looking at these financials, about why you should start incorporating that into your practice. Thanks everyone for tuning in, and have a wonderful day.